Hey everyone! So in this video, I'm going to be discussing what an accredited investor is and a couple different investments that accredited investors are able to invest in. So right off the bat, the accredited investor designation is a standard set by the SEC. And basically, it's a set of standards that shows that you yourself are capable of performing due diligence and you yourself have the financial resources to withstand possibly losing money in an unvetted investment vehicle, right? So the U.S. government, they vet the investments you have on the stock market. The due diligence is done already to vet the company and the established structure of the company. So whenever you go outside of those types of investments, you are taking on the risk of due diligence. Whenever you do that in real estate, for example, or any other types of investments outside of the typical investment vehicles. So the SEC basically came up with these standards as if you fall in this category, you can make investments of this kind. And it's important to note that you must have had either one of these two statutes for the past 2 years and be able to prove that you are going to maintain it in the current year. So it's one out of the two of these, and a lot of people don't realize that. So either one, to have $1 million net worth, not including your primary residence. Okay, cannot include your primary residence. And the second item is an earned income, and as of 2020, it's greater than $250,000 if you are single, and greater than $300,000 if you are married with a spouse. And again, you have to prove that not only did you have that income or net worth in the past 2 years, but also that you are going to maintain it in the current year in which the investment is going to be made. So why even consider accredited investment type strategies into your portfolio? Why is that even something that you should consider? Well, as of 2020, if you max out your retirement savings outside of just the tax sheltered portion, which is $25,000, which is for an IRA and a 401k, you can put up to $57,000 a year in the retirement bubble, in that sort of umbrella of retirement. Is $57,000 a year, and this is really powerful for small business owners. So let's say you're maxing that out, or at least maxing out the $25,000, and perhaps you have other investments on the side. Maybe you have a financial advisor, maybe you got some index funds going, perhaps you also have your real estate funds going. Maybe you build up, save up for real estate, invest in real estate. You have all that going. So it's like, once you have that foundational stuff going, now you can look at other creative ways of further diversifying your money. Some of these investment types are not as affected by big changes in the stock market. So when you see someone who has a heavy stock portfolio and then the stock market drops by 60% or something crazy and they lose a huge portion of that, having investments outside of that as your primary vehicle can help on the downside. And remember, when you do your entire investment strategy, it's not just about what are things that I could do to get really high rates of return, but also what are things that I could do to prevent losing any of the principal? How do I protect the golden goose that lays the golden eggs? So accredited investment opportunities are typically higher yield opportunities that allow you to diversify further. And you can get into stuff like hedge funds, private equity, venture capital, and REITs that are not publicly traded. And when you can structure any of those types of investment vehicles properly, and you have it set up in a way that you are protected and in a way that you can maximize your return, you have an opportunity for better returns with half the volatility. You don't have the same chaos that exists in the stock market, where if something happens in China, you lose 30% of your portfolio. Now, what is different, though, about the stock market is that it will require not only that you have the right education, but that you also have the right team in place in order to execute any of the strategies that you decide to undertake. Right now, the average, just so you are aware, is between 16 to 24%, right? So that's higher returns than the average for the stock market. Not only that, but you're able to achieve those returns because you can protect your downside a lot. If you can invest in things that have a principal asset as collateral, at least to prevent you losing the entire amount of money that you have invested. Now again, this is not true for every single investment out there. It falls upon you as the investor to do the due diligence and to find the right professionals to work with and to consistently educate yourself. As you continue to educate yourself and you continue to work with your team of professionals and they grow and learn as well, you're able to get a more comprehensive plan the longer you do it. Which, the longer you do it, the bigger your wealth grows, and then you're able to rise to the occasion of your wealth and invest that new wealth in ways that can be both long-term growth and stability, give you stability in your portfolio. All right, so moving on to hedge funds. A hedge fund, just to give you an idea, it's not necessarily a specific investment product, but more of a generic term that covers an array of investments that you can make within the hedge fund structure and how a hedge fund works. So right off the bat, the typical hedge fund investment is around the $500,000 mark. Right? So that's a big number. A lot of people hear that and you're like, oh man, that's huge. I can't invest in that. Well, yeah, maybe you can't invest in that now, but what about 20 years down the road? If you spend your time learning how to do this now, 15 years, 20 years down the road, you're able to actually make the leap. You're not making the leap uneducated and without a team in place. You can make the leap by building your wealth building team, following the strategies that are in place that you can even learn from this group, and then educating yourself about other investments, finding a coach that could help you with those investments. And then when you build up your wealth to that point, boom, you can make the leap. First, I want to let you know, even though the average is $500,000 to get into a hedge fund managers are allowed to accept up to 35 participants in a deal that are non-accredited investors. And for people who have an income or net worth greater than $100,000, you can invest up to 10% of your income or your net worth up to $100,000, whichever one is less. So you actually might be able to get into a hedge fund earlier than you think, right? A 5-year, 10-year horizon is not an astronomical amount of time that you can take to learn some of this stuff and then start applying it and start building to be able to get there and then make the jump. Make the jump already knowing what you're doing, already having a team in place, already understanding the investment that you're going to move into. And then from that point further, you are in a different type of investment strategy that will give you more stability in your portfolio. Now, here's a big difference about hedge funds that is different from like a mutual fund that you could get from a financial advisor, okay? And it's how the fund managers are compensated. You see, the managers for a hedge fund are compensated as a percent of profit that they make for you. So unlike a mutual fund or a financial advisor who is compensated as a percent of funds, the percent of total funds in the account, when you're in a hedge fund, the manager is only compensated if they make you money. Only if they make you money. So having the right hedge fund manager is extremely important, but they're also going to be working very hard to get good returns for you because that is how they get compensated. And that's their fees may be higher than the fees that you would have in a typical financial advisor setting. So it's good to understand the fees. But at the end of the day, if they're only being compensated on the profit that they earn you, they are likely to get you a higher rate of return than financial advisors who are compensated simply based on the total amount of funds under management that they have. And again, remember, not all financial advisors are compensated that way. In my opinion, it's preferred to have a fiduciary financial advisor who does not use that compensation structure. So it's just something to be aware of. So typically the structure is set up as a limited partnership or an LLC, and they can hold alternative securities. So they can have real estate within their investment portfolio as well. They use different long-term and short-term strategies to hedge risk, right, to get you the best returns possible. So they use a balance of both short and long-term strategies depending on what's happening in the market. And they use things like leverage and short selling in the stocks, which is aimed to achieve you at least reasonable returns regardless of what the direction of the market is headed. Whether it's headed up or whether the market's headed down, they're able to get consistently positive returns for you, or at least more so than the typical financial advisor is. So now into private equity. Private equity is crazy because it could you could be investing as little as $250,000 up to $25 million. And investors in this field, in this type of investment vehicle, are investing directly with the private companies or engaging themselves in the buyouts of publicly traded companies, which is a little more complicated, at least more complicated than this video. All right. Firms raise money from institutions and extremely wealthy people who are looking at alternative investments besides the typical investment vehicles I told you. And they're looking at people that are investing money in buying and selling businesses. When they reach a specific amount for the hedge fund, for the private equity, it closes, the fund closes, and then at a predetermined date in the future, the fund is liquidated, and then the profits distributed. Typically, again, every deal is differently, but it's about a 10-year horizon. So this is not an investment vehicle in which you have a lot of liquidity with your cash. The structure, again, you're going to need a team of professionals to help you with this, both your CPA, a lawyer, both a bit with business structures and taxes. But you will have to set up a limited partnership, which would own 99% of the shares, and then a general partner, which is the 1% share owner, which has full liability, and they are the ones responsible for actually executing and operating the investment itself. So if you don't understand what a limited partnership, general partnership is, and how that structure is affected, let me know. I can shoot a video about it. This can go under the Biz Op section, just to give you an idea about how businesses are structured and how it works and what it means to you as far as what your liability could be. Setting up partnerships are not as simple as just going on LegalZoom and putting a partnership together. You might be legally liable if your partner goes out and decides to take out debt in your business or something. So just something to be aware of as far as how structures are set up and what vulnerabilities you may have because of certain structures. So venture capital is a sort of form of private equity, and it's really more focused on startups, early stage in the company or emerging companies that have been deemed to have a high growth potential. You can use a venture capital firm to manage an investment portfolio. So you invest money with the venture capital firm, and they go out and find these deals and look into these types of companies that are looking for venture capital. And there's an entire process that you go through to evaluate a company. It's not just from is this a product that may or may not do well, but how is the company structured? How is the cash flow of the company? What sort of policies do they have in place to address their logistics, to address personnel, hiring and firing of people, their payment structure? I mean, there's a lot that goes into how well a company may do over time. So if you went to a firm that dealt with this, they can weed through a lot of that information and kind of whittle it down to the most important factors and what companies that they themselves feel might be doing well. Now, you'd have to go do the research on those companies and see how well they've performed in the past. Again, past performance does not indicate future results, but it is one of the few indicators that we have to judge the quality of an investment product. So yeah, I hope this video sort of opened your mind a little bit to other investment vehicles that are out there, sort of lower volatility vehicles. There's a lot more information about investing beyond just the stock market. And again, I always want to bring the focus to education, financial education. And it's beyond just basic financial education when it comes to just budgeting and saving for retirement. Because understanding how your money can work to grow you wealth and to eventually be able to earn you more money than you can make yourself. I mean, that's something that just taking some time to educate yourself, you can set that up as a reality for yourself. And really, you can't put a price tag on that. So, right now the price tag is time, just taking the time to learn. And I highly recommend that you do take the time to learn and ask your questions and invite as many of your friends and family here so that they also can get this very valuable information that may change their life. It may change the way that their retirement works out for them. Small changes now can have an astronomical difference on what your life looks like 30 years, 35 years, 40 years down the road. And I hope that I can at least add a positive impact to that.